Good day, my name is Larry Pruss and I'm the host of Tech Talks and the Managing Director of SRM Perspectives. I'm also a member of the U.S. Faster Payments Council. I serve on 2 working groups there, and I'm a fellow with the Digital Euro Association. Strategic Resource Management, the consulting company I work for, is a full-service consulting company servicing financial institutions, primarily banks and credit unions, but also fintechs. My primary work function is advising clients on emerging technologies and trends. I frequently speak about the underlying technologies these new competitors are using to compete against traditional finance. Today I'm pleased to be speaking about the emergence of non-traditional competitors in the financial services space, who they are, what makes them different, what technologies they're utilizing, and I'll end my talk discussing some challenges, the outlook, and implications for financial institutions. From my research, it's clear that many of these companies are playing the long game and targeting younger clients, and particularly the $60 to $70 trillion of expected wealth transfer that will occur over the next 5 to 10 years. These competitors market differently, they target differently, they price differently, and they leverage different technologies. To help frame today's discussion, it's worth mentioning a recent letter that JP Morgan CEO Jamie Dimon sent out to his shareholders. And what he laid out were the threats facing the banking sector. So when I'm talking about banking sector, I'm going to talk about banks, community banks, credit unions, large banks. He said, quote, "The growing competition to banks from each other, from shadow banks, from fintechs, and large technology companies is intensifying and clearly contributing to the diminishing role of banks and public companies in the United States in the global financial system." So again, for the credit unions out there, it's fair to say that this is exactly what's happening to their industry as well. So again, this is applicable to community banks and credit unions. So the pandemic changed how people transacted and accelerated many technologies and reinforced emerging behaviors. And that essentially happened when people were locked down and they were looking for new ways to continue conducting commerce. We observed at that point the mass adoption of QR codes, near-field communications, which are the tap and go on your cards, P2P payment apps, digital assets, blockchain, online shopping, and contactless delivery. They all took off. And there's also a growing generational preference for conducting business online and not in person. My kids pay for everything with Apple Pay and Venmo, which makes sense given that these are financial tools that they could use before they turned 18. In fact, I use PayPal for just about everything, rarely pull out a physical plastic anymore. In short, we're training new generations to move away from the old forms of payments, being cash and plastics, and many younger people don't even know what a check is. I personally write less than a dozen checks per year and infrequently use physical cards. Again, Apple Pay works for just about everywhere. The pandemic, shifting generational preferences, and new technologies, particularly cloud, blockchain, and mobile, has led to the explosion of non-traditional competitors. These include neobanks, digital payment platforms, buy now, pay later, big tech, retail giants, personal financial management tools, so PFMs, and Insurtech. The tools of our trade and our technology and the playing field has dramatically changed. It's worth taking a little time to talk about 2 companies that didn't adapt to similar changes in technologies and consumer preferences. For those of you who've seen me talk before, you know I like to use the analogy of Blockbuster versus Netflix. In the 1990s, Blockbuster had reached its peak. They had about 9,000 stores worldwide, and the company had 65 million registered customers and a $3 billion valuation. What happened? Well, the internet and Netflix, right? They didn't adapt to new technology nor anticipate the changes of new technology, and ultimately didn't respond to their changing consumer preferences. So Netflix at the time realized that the internet was an opportunity to stream movies. Interestingly enough, the streaming and the band rate wasn't high enough for Netflix to do that, although they knew that ultimately it would get there. So they had an interim step, which a lot of people might remember, is they sent out physical CDs in the mail. And that was still more convenient for their customers than someone going into a physical store location, picking out a movie and bringing it home and then having to drive back to that store to return it. They could just ship it in the mail. When the internet came along, obviously Netflix streamed live movies. Blockbuster really did not adjust to any of that, and as a result, they're really no longer in business. They went bankrupt. Another good example of the industry failing to respond to new technologies is what happened to the cab companies versus Uber and Lyft. Within less than a decade, rideshare apps have won the majority of ground transportation business of both rental cars and taxis. This is really a great analogy, as the taxi industry was in a similar situation as the banking industry, yet they flubbed it. So if you think about the taxi industry, heavily regulated, high barriers to entry. If you want to start a taxi company, you need a fleet of cars, you need a repair shop, you need parking, you need a dispatch center, those were highly regulated, taxi medallions and whatnot. So they were sure they had enough barriers to entry and enough of a moat that competitors would never disrupt them. Obviously, we know how that ended. And you think about what taxi companies did was they kind of connected people who obviously needed rides to those taxis. Well, Uber and Lyft came along and did the same thing using technology. So they connected people who had cars to drive, which obviously didn't require Uber or Lyft to have their own fleet. And they connected those people with people who had needed rides, and they did that all electronically. And the question I always often ask bankers is, do you think that applies to banking? And I think the obvious answer is yes, it does, because at the base of it, banks, credit unions connect people who have money to lend with people who have borrowing needs. And could you do that electronically? Absolutely. In fact, in the digital asset space and the DeFi space, that's done very frequently, and both ends of that trade tend to get better pricing. So again, just some great analogies there about two situations where an industry did not respond to changing technology or consumer preferences, and that's worth thinking about as we go through this and talk about the different banking competitors that are leveraging new technology and the consumer preference change. So neobanks obviously are a type of direct-to-customer client or direct-to-member that operates exclusively online banking without a traditional physical branch networks. Data suggests there's about 23 million neobank customers in the U.S., and that will grow to about 50 million users by 2025. So fairly significant chunk of the market. Many neobanks aren't actually banks and lack the features that meet the legal requirements to be a bank. Most neobanks target younger customers, focus on building credit, small loans, payday advances, and money transfers. In fact, if you look at a lot of these fintechs and their landing pages, you'll see that they really are focusing on the primary products are small loans, payday advances, money transfer, which is very different than most banks and some credit unions. Credit unions, I think, tend to have similar marketing, but certainly most banks, particularly the large ones, if you go to a landing page, they're going to be talking about their credit cards, usually high yield savings accounts, things like that. So marketed very different, marketed to a different population. These neobanks often utilize influencers for marketing. For example, in 2023, Klarna, the Swedish buy now, pay later fintech, launched a multimedia campaign in collaboration with Paris Hilton. Also in 2023, Ryan Reynolds promoted a payment company called Nuvei, I think that's how it's pronounced. And again, just a good example of using influencers for marketing, something that you typically don't see in the banking or credit union space. There has been some question about profitability as it relates to neobanks, but we witnessed a performance turnaround certainly recently as some of these neobanks began expanding their services with a wide range of bundle services. Most of them in the past have grappled with issues such as low retention rates and challenging unit economics. A contributing factor was that many customers did not use neobanks as their main accounts. This was exacerbated by the dependence on slim interchange fees as their main source of income or revenue, cheaper rates, and no monthly fee payments that cut in their profits. Again, we've seen a turnaround, and some of these are starting to become profitable. I would encourage everyone to think about Amazon. It took a long time for Amazon to become profitable, but obviously they put a lot of mom and pop shops out of business. So that's a cautionary tale for the financial institutions out there. Just because something isn't profitable in the short term doesn't mean that it won't win in the long term. A couple examples of this profitability turnaround would be MoneyLion, which recorded its first positive EBITDA in the first quarter of 2023, and Neobank Dave achieved profitability in last quarter of 2023. I mentioned Dave because it's also a good example of competitors leveraging new technologies. Their banking app, also called Dave, is playing up their AI capabilities. They're also touting cash AI underwriting model and their real-time member support. Dave GPT can answer questions, set up direct deposits, manage accounts, and more with an 88% resolution rate. So as I go through this presentation, the way these slides are set up is, I give some examples of the particular emerging competitor, and then what products they offer, and you'll see that they all of these offer bank-like products, but some of them focus on very different segments and very different products. So in the case of neobanking, probably most similar to traditional banking, they offer checking, savings accounts, debit, credit cards, loan, cash advances, investment products, budgeting tools, things like that. Differences from traditional banking, how to highlight that as well. And this is where you will see those differences, right? A digital first approach, absence of physical branches, innovative features such as high yield savings, EWA, which is earned wage solutions, lower fees, higher interest rates, emphasis on financial wellness, etc. And then I will also highlight the technology differences. And I won't read through all of these, but I just want to make sure that everyone understands the approach we're going to take here. Technology in this case would be more cloud-based infrastructure. So, leveraging some of the new cores out there that are more cloud-focused instead of kind of on-premises. They're using open APIs for integration with third-party services, leveraging API-powered financial planning tools. So that's neobanks. Next, we can talk about fintechs and in particular digital payment platforms. So these are companies that rely primarily on technology to conduct the fundamental functions. Some of the examples are ones that have been around a while: PayPal, Venmo, Cash App, Chime, products that they offer, peer-to-peer payments. So that's a big focus of these. Mobile wallets. Some differences from traditional banking, a lot of instantaneous transfers, so they're leveraging some of the real-time payment functionality. Social payment features, you think about Venmo and how they've kind of gamified moving money or using money. Limited banking fees, user-friendly interfaces, and then from a technology standpoint, secure encryption protocols, biometric authentication, integration with blockchain. It's worth considering that digital payments are the leading fintech segment in the U.S. with a market value of about $1.2 trillion. 60% of credit unions and 49% of banks in the U.S. believe that fintech partnerships are crucial. By the forecasted period, the U.S. will account for more than 62% of the global fintech transaction value. The U.S. customer fintech implementation rate is about 46%. Customer fintech implementation rate for global money transfers and payments is about 75%. 75% of global customers have used at least one fintech service to pay online or using a mobile application. 70% of U.S. customers say that mobile banking will or does represent the future. Unlike neobanks, many of these fintechs are focused on a particular bank-like solution, in this case, payments and money movement. These fintechs are taking advantage of the changing landscape of payments, a shift towards cashless transactions and faster payment technologies, again driven by changing consumer expectations. Next, we'll talk about buy now, pay later solutions, so BNPL. These are typically short-term financing, allow customers to make purchases and pay for them over time. They're the modern-day version of layaway or installment loans. The latest data indicates that a large share of buy now, pay later users live in the U.S. In fact, the latest data indicates that there are currently about 79 million U.S.-based buy now, pay later users, and that's a lot. That's an increase of about 56% over the previous year. There are more than 400 BNPL users worldwide, so almost half a billion. By 2027, it's expected there'll be 900 million buy now, pay later users, increase of about 125%. So almost a billion buy now, pay later users within the next, 3 years. Unlike traditional credit cards, BNPL options often don't charge interest. However, those apps make money by charging retailers a small fee. Some also charge consumers late fees. Others make money from advertising or have subscription models for extra channels of revenue. They tend to leverage banks behind the scenes, as do most of these fintechs. Some of these examples of banks would include Sutton Bank, Cross River, Web Bank, and Celtic Bank or Celtic Bank. In recent news, Apple announced that Apple device users will soon be able to tap into buy now, pay later loans from Affirm for purchases. Affirm will surface as an option for Apple users on the iPhones and iPads later this year. Apple also said that installment loans via credit and debit cards would be available on Apple Pay in the U.S. with Citigroup, Synchrony, and Fiserv-related issuers. So again, Apple is adopting buy now, pay later. In fact, they actually have their own version that lets users repay in 4 installments over 6 weeks. Affirm has an array of longer-term offerings that can be repaid over a year or more. So this should be a complementary offering to Apple's existing solution. Big tech companies probably are the largest threat, really. These companies are some of the largest in the world. They have deep pockets, significant loyal retail relationships with their customers, particularly large amounts of transactional data, and they integrate solutions that touch every aspect of their customers' lives. Good examples: Apple, Google, and Amazon. Obviously, starting to increase embedded financial services into their ecosystem. Products they typically offer, debit, credit cards, loans, digital wallets, rewards. I've seen small business lending. Some of the differences from traditional banking would obviously be massive user bases. Just to give you an idea how big some of these companies are, Microsoft has a $3.3 trillion market cap with 1.4 billion customers. Apple's got about $3.2 trillion market cap with 1.3 billion customers. Google, $2.8 trillion market cap with 1 billion customers. Amazon, $1.9 trillion market caps, almost $2 trillion with 310 million customers. A little smaller for Amazon, but again, big market cap. And then Facebook Meta, which is probably one of the biggest concerns, and obviously had, for those in the digital asset space or interested in digital asset space, launched Libra, which was a digital asset that was going to be based on a basket of currencies. And Congress and a number of other regulatory agencies around the world shut it off because they saw it as a big threat. But you think about how many customers Facebook and Meta has and how many kind of financial services they could sell to those customers. They've got 3.5 billion customers, so half the people on this earth Facebook Meta has a relationship with. So again, they probably pose some of the largest threats. Some of the technology differences really are around big data analytics. They are leveraging AI-driven personalization for offers, predictive analytics, seamless omni-channel experiences. There may be an opportunity for these competitors to also leverage new payment mechanisms like stablecoins or central bank digital currencies that would reduce or eliminate merchant fees and could cut out the payment network. So again, these are the ones I think probably have some of the longer term threats to traditional finance. And then like big tech, retail giants have an advantage of, again, pre-existing retail relationships with their customers and massive amounts of transactional data. They generally offer products with relationships with fintechs, so there's a partnership opportunity potentially. For example, Walmart uses Green Dot to enable bank-like solutions for free cash deposits, check cashing, money transfers, installment financing. Last year, Walmart partnered with a fintech called Pay Near Me to enable frictionless payment of bills in cash at Walmart stores. On a related note, the credit card partnership between Walmart and Cap One ended when Walmart terminated the relationship because Cap One was taking too long to process payments and mail replacements card. But again, just a good example of Walmart partnering with financial institutions. Some of the differences there, again, kind of matching the big tech, but omni-channel experience, integration with the retail ecosystem. So because of that retail pricing, they can often offer much lower product pricing than traditional finance would offer, only because they're making the money on a particular product sale. Leveraging that customer data, technology differences, again, advanced analytics, integration with e-commerce platforms, that's a big one. In the earlier quote, when I started the talk, I quoted Jamie Dimon from JP Morgan about an increase in non-bank competition, and when he actually directly mentioned the initiatives made by Walmart to offer customers banking style services. So he saw Walmart and retail giants as one of the biggest threats to traditional finance. Personal financial management tools, or PFM. This is a service for mobile devices that allow users to invest and manage their money in various financial markets. Some examples: Betterment, Wealthfront, Ellevest, Robinhood, Acorns, Coinbase, and Investify. This market is expected to grow at a compounded annual rate of about 5% from 2023 to 2030. This is one of the areas I personally think there's a large opportunity for community banks and credit unions to offer similar solutions, considering that there's somewhere between, again, 50, 60, $70 trillion of generational wealth in the next 5 to 10 years are going to transfer to the millennials and Gen Z. So to the extent that you don't have a relationship with those customers or members, you're going to miss out on an opportunity. And a lot of them, while they do not have a lot of wealth right now, they do have investing needs. They're just starting off, and these fintechs recognize that. In fact, the examples I've listed, almost each one of them have a unique offering, which is a little different than some of the others in that the fintechs in a particular category have similar sort of offerings. These have very unique offerings, and thus it's worth spending a few minutes talking about them. And again, it could be an opportunity from a partnership standpoint to offer similar sort of products and services to your customers or members. So for an example, while you probably have a wealth management business that services maybe 1-2% of your client base, for everybody else that doesn't have significant amounts of money to invest, they're probably going out to the Robinhoods or the Acorns of the world to get those servicing. So let me spend a couple of minutes talking about some of these different offerings, because they are very different. Betterment's focused on tax-efficient investing options like tax loss harvesting and estate planning or trust accounts. Again, things that traditionally financial institutions would have offered, but very narrow focus for Betterment. Wealthfront offers automated dollar cost averaging and investing in index funds, automated bond laddering, individual stocks, and high yield savings. Ellevest offers robo or automatic advising, private wealth management, and financial literacy, targeted mostly for women. So that's an interesting one. They recognize that women have different earnings, which are about 83 cents for every dollar a man makes, and that women, 74% of them die single because they live longer, and thus they have unique investment needs. So there's an example of a fintech identifying a very particular need and offering a very particular solution to the market. Robinhood, which is, most people have heard of Robinhood, very much focused on beginner investments, with low investment amounts, and had, until at least recent lawsuit, focused on the gamification of investing. For example, the use of digital confetti that would rain down from the top of the screen after a customer completed their first stock trade. Also included popular emojis with push notifications. They offered commission-free trades, offering a chance to win big stocks like Apple or Microsoft to buy an electronic version of a scratch-off lottery ticket. Again, really unique approach, kind of gamification, gambling-like approach for young investors to get them hooked on investing. They also offer margin loans, options, and crypto. Related to crypto, Robinhood just announced that they'll be acquiring Bitstamp, which is a crypto exchange, for $200 million. So they still see that as an opportunity. Oddly enough, even though they currently, I think, have a Wells notice served from the SEC regarding their existing crypto business. Acorns focuses primarily on savings via investing spare change in education. So again, small amounts. Coinbase focuses on crypto investing, and then Investify offers PFM-like solutions for credit unions and increasingly community banks. So that's a company we've worked with in the past. Again, a big opportunity, I think, from a partnership standpoint are these personal financial management tools. And again, to service that membership customer base that is not being serviced by a wealth management relationship. Next, we have peer-to-peer lending. I mentioned earlier DeFi, which is kind of an alternative to TradFi, which is traditional finance. So peer-to-peer lending enables individuals to obtain loans directly from other individuals. So kind of crowdsourcing. Internationally, peer-to-peer lending market has attained a valuation in US dollars of about $295 billion. That's back in 2019. By 2023, that valuation topped $458 billion, so almost $500 billion. So that was almost 2x growth, and recorded a record CAGR of 6%. Growth in this segment is expected to increase by 40% in 2024. So again, a lot of growing use of direct peer-to-peer lending, and that's something that is in direct competition to traditional finance. Domestically, here in the U.S., there are about 54 million peer-to-peer lending users. That was about 6 years ago. It's more than likely to double to about 126 million in the current year. So that's almost half of Americans that are using some sort of peer-to-peer lending, or have at some point utilized peer-to-peer lending. Borrowers request personal loans on these platforms, and investors, whether they're individuals or institutions, then will fund those loans. Investors can consider things like borrowers' credit scores, ratings, histories, and category of the loan. This is a democratization of lending, offers both challenges and opportunities for traditional finance. While these solutions are competitive, similar to the way that Uber disrupted the taxi industry, these P2P loans could also become a feeder system for traditional finance, as they are still reported to credit bureaus and allow individuals to grow their credit. So considering these are targeting mostly for small loan amounts and new users to kind of traditional finance, these may be a way to kind of bring them into the fold of what traditional finance offers. Some examples would be Lending Club, Prosper, Funding Circle, Upstart. They, again, focus on small loans. They differ from traditional banking in that it's a direct borrower to lender interaction, and as a result, they offer lower fees and higher interest rates. So better rates on both ends of the trade. Faster approval process, focus on financial inclusion and social impact focus. From a technology differences, some big technology differences here. They often use blockchain to integrate their loan origination and settlement, making it much faster than traditional finance, and use advanced algorithms for alternative credit scoring. So they'll make use of like non-credit type trades, so things like rent payments or liens and stuff like that might not be on a traditional or reflected a traditional credit score. And then the last one we'll cover, and then we'll talk about some of the opportunities and risks for financial institutions. But this last category, which would be Insurtech. In the U.S., we have the largest insurance market. As a matter of fact, the largest in the world, and it's really a hotbed for Insurtech companies. Insurtech companies, or Insurtech, refers to use of technology innovations designed to cut costs and improve efficiency from the current insurance model. Some examples be Lemonade, Root Insurance, Oscar Health, and Metro Mile. The products they offer are kind of traditional, but with a different spin. So auto, home, renters, health. They also offer some like pet insurance, but they have a more streamlined digital experience that traditional financial institutions or traditional insurance companies might offer. They have an emphasis on personal digital customer experience, unit-based pricing models, AI-driven underwriting, and seamless digital claims processing. Obviously, from technology differences, they're leveraging AI machine learning, user-friendly apps, big data analytics, and again, personalized solutions are offering. In the U.S. Market, the current market is about $49 billion, expected to reach $66 billion by 2029, growing at a compounded annual growth rate of about 6% during that forecasted period. We're starting to see increasing disruption of the traditional insurance models, but there are potential synergies with and or cross-selling of banking products. Insurtech solutions offer insurance that some FIs or larger companies don't offer, like pet insurance. I mentioned that earlier. So what are some of the technologies that we're seeing leveraged by these these emerging competitors, and most of them leverage almost all of these emerging technologies, whereas traditional finance has been a little bit slow, a little bit more cautious about leveraging some of this technology. So, big obvious one would be AI and machine learning that's used in kind of customer service, risk, fraud management, marketing, and general efficiency gains for these companies. A lot of API integrations, particularly for the coming open banking initiatives. We see an increasing importance of cybersecurity and data privacy. A lot of them have cloud-based or blockchain solutions versus legacy core platforms. So the idea of a shared ledger system amongst maybe providers to provide efficiencies and immediate settlement, whereas every traditional finance has its own ledger and has to go through a reconciliation process, and transfers and money movement are slow and cumbersome and sometimes filled with errors. We're seeing also an increasing digitization of money. Most people know I like to talk about cryptocurrencies, stablecoins, tokenized deposits, and CBDCs. We're starting to see that reach into payment processing and asset management. There's a real growth of RegTech, which is helping financial institutions and their competitors stay compliant. We see a lot of use of biometrics and voice technologies needed to combat some of the newer fraud that's being enabled by technologies like AI, where we're starting to see deep fakes or synthetic identities. So, just some of these things on here. There's a couple others I didn't mention, like gamification, but get a good feel for the overall Internet of Things, the technology being utilized by these emerging providers. And again, it's different technology than what we see in traditional finance. So what are the challenges for traditional finance? Over the year ending third quarter of 2023, total assets in financial and insured credit unions rose by about $79 billion, or 3.7%, to about $2.23 trillion in assets. Federally insured banks rose about $625 billion, or about 2.8%, so a little slower growth than credit unions, but their total assets raised to $22 trillion. So again, huge assets traditional finance still has. However, we do expect overall financial institution loan rate to slow in 2024 due to tight liquidity, persistent high interest rates, reduced consumer demand for durable goods. Consumer spending on servicing debt will rise in 2024 and dampen consumer spending. Additional headwinds include all of the things we talked about today, right? So, and some of the challenges just are inherent with traditional finance, like legacy technology, legacy culture, talent acquisition, retention challenges, changing consumer member demographics. So we talked about that earlier. Continued regulatory change. So things like Credit Card Competition Act. All of the new technologies that these fintechs are leveraging, and then obviously these new fintechs or competitors that are out there, they're competing with traditional finance. At times it feels like a death by a thousand cuts. So what's the outlook? I'd say more of the same. However, we do expect, depending on the election, more regulation of the emerging competitors. This will likely come from the CFPB and banking regulators. For example, the FDIC has been increasingly scrutinizing a lot of banking as a service relationships, which are the foundation of many of these emerging competitors. So there is some hope out there that some of the competition might slow, or at least the growth of the competition might slow. But I would say we're going to see this continued evolution of non-traditional banking landscape. The regulatory challenges are going to be both for traditional and non-traditional players. So it's new for the non-traditional players, but it's not new for traditional finance, right? We deal with regulatory change all the time. You will continue to see the market disruption. We're going to continue to see consolidation. And per David Bowie, chit changes. And that's what we can expect in the outlook for this year and for the coming years. So what are the implications for TradFi? I certainly don't have all the answers, but some of the obvious answers or areas to focus on would be, understand and adapt to your changing consumer or member preferences. Consider collaboration versus competition with these non-traditional financial service providers, right? So if you can't offer the services yourself, either from a technology standpoint or from a margin standpoint. Maybe partner with a fintech and allow them to offer that service to your customers or members. There are opportunities for innovation, in these products and services. So think about product design. I can't tell you how many times I've talked with financial service executives about designing a product, and they're like, "Oh, they come out with a new credit card, and it's got to have all these massive points, and it's for high net worth individuals." And I say, "Are you designing the card for yourself, or are you designing it for your customers or members?" Like, really think about that, and not even just who your current membership base is, but who's your future membership base. A lot of our clients, we see their current customers and members starting to age out, right? But they're not really targeting those younger clients, younger members, younger customers the way that some of these emerging competitors are. And so you can learn from that. And then, of course, the importance of digital transformation, and everything's going digital. We offer a lot of consultancy services around this, but make sure you've got a digital strategy in place. And so some recommendations I would have would be, you must adapt, right? Adapt is critical. Adapt or die. You must remain competitive. You're going to want to embrace innovation, be agile, focus on customer member centricity, because certainly those fintechs are. They're really focusing on lowering barriers to entry. You're going to want to focus on that as well. As I mentioned before, embrace the digital transformation and start to leverage the technologies, these new technologies. Like, learn about them. I know some of them are complicated and doesn't come naturally, but find someone within the organization that can be a champion, whether that's technologies like cloud, whether that's AI, whether it's blockchain, so that you can meet the evolving needs and expectations of your customers and members. Continue to focus on, setting up a culture of innovation. I mentioned looking for champions within your organization. You're going to want to identify potential opportunities to collaborate with non-traditional competitors. I mentioned that before. You're going to want to target and build your products for your younger generation. And then, you've got other partnerships out there that you can leverage, like leagues, credit union leagues, CUSOs for banks, industry relationships. A lot of those kind of trade organizations that may be able to help you with education or thinking about this changing landscape. And then leverage external resources. SRM is here to help you to develop some of that strategic focus to help you compete with those emerging competitors. Help you think about your digital roadmap, help you think about the relationships you've got with your vendors, and are they servicing you properly, and how are those things priced, right? So pick a partner like SRM that can help you work through this. These are complicated times and require people with a lot of experience. So in summary, we've seen non-traditional competitors disrupt traditional finance industry, right? We've been talking about that the whole time. Fintech versus traditional banking. What are those non-traditional competitors doing? They've got a customer-centric approach. They're leveraging new technology. They've got seamless digital experiences, data-driven insights and personalization. We hear that all the time in traditional finance, right? Leverage your data, but how many of you are actually leveraging that data? Offer innovative products and services. Like, some of these are really interesting. Like, again, the earned wage access solutions, the payday advances, some of the things that some of our older credit union or community bank members or customers may not need, but the younger folks certainly do. And then opportunities do exist for traditional finance, right? And those are the adapt to changing preferences, collaborate with fintech, innovate on new products and services, and leveraging the technology. So, hopefully this discussion was useful and was able to spark some creative thinking about how not to end up like Blockbuster Video or one of the many cab companies. Again, analogies I love to use, but I think they're relevant ones for traditional finance. If anyone's interested in more detailed conversation with your board or your executive team, reach out to SRM or reach out to me directly. I'm on LinkedIn. Happy to have some more detailed conversations or direct a discussion around this or many other topics that we have. We have a catalog of a lot of these technologies, everything ranging from changing competitive landscape to digital assets to regulation to payments to, we have quite a large catalog of topics that we can speak on, that we're experts on, and that we can get the right people in the room to really help your organization plan for the future and compete. So with that, I want to thank everyone for your time today, and look forward to having you on future Tech Talks. We do these every other Thursday at 4 o'clock Eastern Standard Time. Normally we have guests on, and I typically will moderate those conversations, and most time we have a live audience. In this particular case, we did have a live audience, but I had to re-record it due to some technical issues. So hopefully, again, this was useful. Apologies for not having a live audience on this one, but hopefully this was useful, and look forward to your participation in future ones. We do record these, so if you aren't able to join one of our live recordings, certainly you can watch the recording. With that, thank you very much. My contact information is on this last slide. And again, I'm Larry Pruss, lpruss at srmcorp.com. And my LinkedIn contact's out there. It's Larry Pruss. Thank you so much.